You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back, everyone, to the show. And today's show, we're going to talk about the S Corporation. So if you're a new business owner or you're just starting to learn about how taxes work, this episode is going to be for you. Today's episode, we're going to talk about who is an S Corp for, who is it not for, why you should set up one in the first place, some potential downsides or traps, and we're also going to talk about how it ties into the real estate space. So to start off, who is an S Corp for? An S Corp is for anyone that has ordinary business activity. So it could be something as simple as maybe you're walking dogs, you have a lemonade stand. We see S Corps used for real estate agents, fix and flippers, professional service firms like lawyers and accountants, doctors, dentists use S Corps. Basically, any self-employed individual that has a normal business activity making about $60,000 or more per year. And the reason I say that, we'll touch on it a little bit later, is you have to make a certain amount of revenue, net profit, in order for it to make sense. You wouldn't want to set up one if you're only making $20,000, $30,000, $40,000 a year. It has to make sense from a tax savings as well as a cost benefit standpoint to actually set one up. Who is it not for? Those who do not think they will be in business long term. And what I mean by that is if it's just a one-shot business or you had a really good idea one year, maybe it's not something that's sustainable for the long term. That's not going to be, the S Corp's not going to be your route, because you're going to have to go through all these hoops to set one up, to be compliant, the administrative burden, just to eventually dissolve it a year or two later when your idea runs out. We threw out $60,000 as a number. I personally think if you're making less than $60,000 net income, I think the cost of the compliance can be more than the potential tax savings. So if your net income wise is going to be below $60,000, I do not think it's worthwhile to set up the S Corporation. And we're going to get into what are those costs in a little bit. But if you're making below 60, probably not a good idea to set one up. If you are going to make $60,000 or more long term, going to be sustainable, then it's definitely something you're going to want to look into. If you're already making over what's known as the FICA wage base, or you're close to it at your W-2 job, this is hard to understand and explain, and I confuse myself sometimes even more by explaining this, but the Social Security Administration places there's a Social Security tax as well as a Medicare tax on all your W-2 wages or any earned income throughout that year. So there's pretty much a ceiling of how much you pay into the system. So for 2022, that ceiling is $147,000. If you're making $147,000 at a W-2 job, you're already paid in to the max that you can for Social Security purposes. So by setting up an S Corporation for business income in addition to your W-2, you're not going to be saving any more money because you're already paid in to the Social Security Administration. Now, if you're planning on leaving your W-2 to set up a business, that's something you can plan for. But if you're already a stable W-2 and you're setting up a side hustle, it may not be worth setting up the S Corp because the tax savings just aren't there. And it's not just $147,000 if you're a W-2, but even some people who are making, say, $80,000, $90,000, $100,000 on a W-2 and they decide to start a side hustle, it may not make sense for them while they're a W-2 employee. Last one, rental real estate activities. We do not want to hold any sort of appreciating asset, typically rental real estate, inside of S corporations. We'll get into that in a little bit further. Why set it up? So we talked about the Social Security tax, the Medicare tax. S corporation is set up to save on self-employment tax. If I go outside and set up a sign and I say I'm walking dogs now, and I was to make $100,000 a year walking dogs, I have the same amount of tax as a W-2 employee, federal income tax, state income tax if that applies to me, I have the same amount of tax as a W-2 employee, but as a self-employed individual, I bear the cost of the employer and the employee. Because I'm the employee and the employer in my business, I pay both portions of that Social Security Medicare tax. So as a W-2 employee, I would be paying 7.65% through my withholding. If you look on your W-2, you'll see two lines. One of them will say Social Security, one of them will say Medicare. That's 7.65% you're paying as a W-2 employee. Now, your employer matches that per part. But if you're self-employed, you have to pay both parts of the Social Security and Medicare tax. So if we go back to my dog walking example, on $100,000 of net income, I'm paying federal, I'm paying state tax, and then I'm paying 15% into self-employment tax. So quickly do the math, 15% of $100,000, you're paying $15,000 a year just in self-employment taxes alone. That's before regular income tax. So it gets very costly to do business as a self-employed individual outright. There's a workaround, and that's the S corporation. So in order to have an S corporation, you have to pay yourself a reasonable salary. And a reasonable salary depends on a few factors. What an average person doing your job in that area makes. You can look at the Bureau of Labor, the Federal Bureau of Labor. You can look at your state, what they treat labor as. In California versus Illinois or Utah are going to have different numbers for that. But you're able to pay yourself a reasonable compensation via a W-2, and the rest you're able to take as a distribution that's not subject to that self-employment tax. So a better example would be if I'm making $100,000 and I'm able to pay myself $40,000 as a W-2, so I set up payroll and I pay myself $40,000, the other $60,000 I'm able to take as a distribution, which doesn't have that 15.3% tax. So the savings on that are, if I take $60,000 times 15% roughly, the savings, if you're making $100,000, the savings by setting up an S Corp comes out to be about $9,500 per year. And I use this strategy personally for my CPA firm. I'm set up as an S Corp. Tons of people who are operating ordinary business activities are set up as an S Corp for this reason. And it has 100% to do with the idea of saving on this self-employment tax. So on $100,000 of net income, you could expect to save almost $10,000 in taxes, which is insane. If you're making $70,000, maybe you're only saving $5,000 or $6,000 in self-employment tax, but even that can make it worthwhile. Also, having an S corporation, because you're taking a W-2, it also sets you up for more creative self-employed retirement plans like the solo 401k. We're not going to get into that in today's episode, but the solo 401k is a true wealth building tool because you are the employer and the employee in your business. And because you're the best employee in your business, you're able to do profit sharing actually in your plan. So your business is able to get a tax deduction for that same amount that you would have contributed to, say, a W-2 401k plan. You can contribute to your own self-employed 401k plan and get profit sharing on that. It's really neat. How to set up an S corporation. So the first thing you're going to want to do is speak with a tax professional or somebody that you trust to see if it's right for you. We talked about before some of the variables that don't make sense, or if going forward long-term, what it looks like. You want to speak with somebody who is going to take the time to not only explain it to you in layman's terms, but also somebody who's going to recognize whether or not it makes sense for you. The first step is to set up an LLC with your Secretary of State, with the state that you're in. So if I'm in Illinois, doing business in Illinois, I'm going to go to my Secretary of State website in Illinois and set up an LLC. That's the first step. Then I'm going to want to get an EIN number, an employer identification number with the IRS. You can actually do this for free by going on the website. You're going to type in your company information and then your status, and you're going to get an EIN number. You then have to file what's called a 2553 form to elect the S Corp status, and you're also going to want to have an accountant or somebody help you out with this. You're going to want to hire a competent bookkeeper and a payroll team, somebody who's going to help you keep your financial statements on a monthly basis, figure out how much net income you have. You're going to want to hire somebody to help you with the payroll side of things also with getting your W-2 issued. It's very important as an SCorp owner that you do take that reasonable compensation via a W-2 before the end of the year. If you do not take this reasonable compensation, you're opening yourself up to a lot of risk from an audit standpoint if you do not take any reasonable comp. The reason behind this is you're essentially taking all your profits without having them being subject to any sort of Social Security, FICA tax, and that's why you need to take reasonable compensation. And last, you're going to have to hire somebody to prepare your SCorp return, and they're normally due by March 15th of each year. Some of the downsides and traps to setting up an SCorp. There's going to be more of an administrative burden to operate your business than if you were just a sole proprietor, right? You're going to have to hire, again, we talked about, you're going to have to set up an LLC. You're going to have to hire a bookkeeper, somebody to help you with payroll, a tax advisor. Those total costs could near around $2,000, maybe $2,500 for the year. So then you have to compare, okay, how much does it cost me to set this up versus what I could potentially be saving? And so that's why if you're making six figures as a self-employed individual, it's a no-brainer in most cases to want to set up this S corporation, because if I'm going to have to pay $2,000, but that means I'm saving $9,500 in taxes, the net difference there is $7,500, $8,000. Of course, that makes sense to go through all the hoops to set this thing up. But again, if you're making a lower amount of money, it may not be worth it from a compliance standpoint to set it up, because the costs to set it up are going to be almost the same whether you're making $50,000 or $100,000 or $150,000. So that's why you have to make a certain amount of net income for it to make sense. Another downside to it is in certain states there's more tax or more legal burden for operating LLCs or S corps. So some states that come to my mind are notoriously California. So California has an $800 flat LLC tax. It's a fee more than it is a tax, but it's $800 per LLC, and that's the minimum. So even if you had no business activity, or maybe you only made $1,000 that year, it's still a flat $800. Tennessee and Texas both have franchise taxes in addition to the regular federal tax that you might pay. So in certain states, it gets less efficient to operate an S corp in those states. Another downside is basis issues in an S corporation. It's a little bit out of scope for this podcast, but it's something to keep in mind that you can only take money out of the company that you're actually at risk for and that you've actually already paid taxes on. So it's something to talk with your tax advisor about, whether or not you're able to actually take money out of the company. What we're going to talk about now is, why do we not want to hold rental real estate specifically in S corporations? So I said before that fix and flippers, wholesalers, real estate agents, they're good to go because they are operating ordinary business activities. Even though they're in real estate activities, they're not holding appreciating assets inside of their S corporation. The first reason why you wouldn't want to hold rental real estate in an S corp is because when you go to contribute that property into that S corp, or you're buying property out of the S corp, it may trigger a taxable gain or loss event on the contribution or distribution from that S corporation. So if I have a rental property in my personal name and I go to put it inside of an S corporation, that can potentially be a taxable event. Another idea is when people want to refinance a property that's in a business, sometimes they have to remove it from their business, get it into their personal name in order to refinance, because it might be at better interest rates, better terms. When you go to move a real estate out of an S corp to your personal name, that triggers a taxable event as well, something we don't want to do. Whereas if I just had that real estate in a single member LLC or not an LLC at all, that doesn't trigger a taxable event. But having it in an S corp and distributing out of the S corp, that triggers a taxable event. We might be hustling backwards, okay? Rental real estate, as I've talked about before, is passive income. And as you know, passive income is not subject to that Social Security and Medicare tax. So you wouldn't want to put rental real estate inside of an S corporation, because now you're subjecting yourself to Social Security and Medicare tax that you aren't subject to if you just had that in a single member LLC. If I have my real estate in a single member LLC or my personal name, I'm not paying Social Security and Medicare because it's passive. If I have it in an S corporation, I have to take that reasonable salary. I might be hustling backwards in a sense where I'm taking income that should have been passive income and now converting it to earned income or active income, as we call it. And how does it tie into real estate in general, right? Because you can have it each way. If I fix and flip, or I'm a wholesaler, I'm a real estate agent, I want to have an S corporation for my ordinary business activities. So whatever operation I'm doing, or I have a real estate CPA firm, I'm going to have an S corporation for my ordinary business activities. And then I'm going to hold my rental real estate, my appreciating assets, inside of other structures. That's either going to be in my personal name or a single member LLC. We do not want to commingle sort of the operations in a sense where I have one company that I do fix and flips in, one company I do wholesales in, and one company I do rental real estate. You do not want to have those activities commingle because they're taxed differently and they receive different treatment. So if you're a fix and flipper, a wholesaler, a real estate agent, somebody operating an ordinary business activity, you're going to have an S corporation for that ordinary business, that business operation. But for anything that appreciates in value, typically rental real estate, you're going to not want to have that in an S corporation. Thanks for listening to this episode about S corporations. If you have any questions or comments, leave them below or shoot me a message on Instagram or Twitter @LearnLikeACPA, and I'll see you guys on the next episode.